Good morning, and welcome to an overview of opportunity zones and a comparison of the pros and cons of opportunity zones versus 1031 exchanges. I'm your presenter, Scott Saunders, Senior Vice President with Asset Preservation, Inc. Asset Preservation is a leading national 1031 exchange qualified intermediary with a headquarters in Roseville, California, and with an office in New York. And Asset Preservation is a subsidiary of Stewart Title based in Houston, Texas. At the very beginning, I just want to go through the disclaimer that this is intended to be a general overview of opportunity zone investments. This is not going to be a deep dive into every nuance and subtlety. There are literally hundreds and hundreds of pages of guidance that we have received and more to come from the U.S. Treasury. In fact, last week we got 169 pages of more guidance. So currently there still are some issues with a little bit of uncertainty and questions that are unanswered. And I want to be very clear regarding this webinar and presentation that the tax-related information I'll be covering should not be construed as tax or legal advice specific to your situation and should not be relied upon in making any business, legal, or tax-related decisions. So you want to get with your personal legal and tax advisors to review your individual and unique facts and circumstances to determine what's best for you. A little bit of my background. I'm a Senior Vice President with Asset Preservation. As a company, we've done over 180,000 1031 exchanges. So we have considerable expertise in that niche. And you can see that I've been involved for many years writing articles on the subject of 1031 exchanges and giving presentations. And more recently, have learned and applied a lot more regarding opportunity zone investments. So we'll be talking today about the interplay between and the connection between Section 1031 and opportunity zones and things that are possible and go through some advantages and disadvantages of the different strategies. There's an outline, and I'm not going to go through each of the bullet points, but really the bulk of the presentation will be focused down below, comparing and contrasting Section 1031 to opportunity zones. And what I wanted to do was really start off is to understand opportunity zones properly. We really want to look at the broader picture. And as you'll see on the next slide, I wanted to provide a 30,000-foot overview of just taxation. Why do we have taxes, and what's the purpose? The federal government wants to create certain incentives in the code to achieve certain outcomes socially. So they use the tax code to do that, to drive investment and to drive capital to desired outcomes. And so a few of them that I've listed here. Certainly many of us are homeowners, and we know that the government encourages home ownership. Why? Well, because homeowners typically are more invested in their local community. They'll keep the homes up better, they keep the yards up better, and they take more of an interest. So the government encourages that. You can deduct property taxes, the mortgage interest deduction, and then upon sale, a separate part of the tax code, Internal Revenue Code Section 121, allows a homeowner that's lived in a home for 2 out of 5 years for single filers to deduct or to not exclude up to $250,000 of capital gain. Married couples filing jointly to exclude up to $500,000. When we look at charities, the government encourages contributing to charities with cash, with used cars to help those organizations. And then finally, Section 1031 of the code. That achieves a lot of great outcomes for the overall economy. It encourages businesses to expand and to grow. And it also does a lot of things for real estate. It helps create more real estate, brings on more supply. It increases the supply of homes, of multifamily properties. It brings on board newer and more energy efficient office buildings. So that's a big view of taxation. Well, why does this tie in with opportunity zones? When we look at opportunity zones, this is a very significant brand new tax incentive, and it applies very broadly. Any investor with capital gains can potentially take advantage of opportunity zones. And it's got to fund certain very specific objectives. It's got to fund new businesses or new development made into a specific area, what is called a qualified opportunity zone. So some new sections were added to the tax code, IRC section 1400Z-1 and 1400Z-2 that define opportunity zones. And now we've got a couple rounds of proposed Treasury regulations that are clarifying many aspects of opportunity zone investments. Well, look on the next slide. OZ is not the Wizard of Oz. It's more like this image here from a movie, Mad Money. It's a potentially excellent investment opportunity that allows investors nationwide to improve their return on investment. What's the intent of opportunity zones? Well, we've got in our country about 1 out of every 6 citizens live in an area that's considered economically distressed. Congress wanted to try and bolster the acceleration of wealth, of capital from affluent areas into these low income and distressed communities. And then across asset sectors to take gains from other types of investments and allocate and redirect those back into real estate and real estate development. So under the Tax Cut and Jobs Act that was passed at the very end of 2017, states could nominate areas and communities that they wanted to have designated as a qualified opportunity zone, specifically to encourage economic development, to revitalize those communities. And this designation stays in place for a maximum of 10 years, so it's a 10-year designation. And a lot of things are intended to come out of this. Certainly, there's a goal to bring on board more affordable housing, to help local businesses in those communities grow. And as they grow, that'll add jobs, which helps the community, and that helps bolster wages, to upgrade underutilized assets through capital improvements. But bottom line is to improve the economic growth and the vitality of these communities that have been distressed and that are lagging behind other parts of the country, to refocus resources and capital to these communities to help them out. And look on the next slide. The number of people that live in opportunity zones is about 35 million people. And I think the quote from Ben Carson, he's chair of the White House Opportunity and Revitalization Council, hits the nail on the head. Here's what he says. Almost 10% of the country's population will now have a pathway to financial success due to the single stroke of a pen. So this is pretty significant. More numbers to look at. $6.1 trillion. Now, trillion with a T is a big, big number. That's how much there are in unrealized capital gains. And about 2.3 trillion of that is with businesses and about 3.8 trillion with individuals. So this is a tremendous opportunity to take all of these gains, or a good portion of them, and then take those funds and redirect them into these economically challenged communities. So a little bit of quick history on it. Opportunity zones were originally developed in 2015 based upon a program, Investing in Opportunity Act. Then under the Tax Cut and Jobs Act, it was renamed the Opportunity Zone Program, and that was finalized at the end of 2017 and then became effective beginning in 2018. Now, it's important to point out, even though we're not quite there yet, we've got a limited time window. So you can make an investment into an opportunity zone up until the end of 2021. So there is an end date with this. What's interesting, and I want to share something, many of you on this webinar are involved in real estate in some fashion, and it's no surprise that as we create more demand for an asset or a property, we start to see an increase in demand, and that has upward pressure on prices. Look what's happened in the last 12 months. Since April of 2018, and this is according to a Zillow study recently reported in the World Property Journal, we've seen values increase in an opportunity zone by about 20%. So in 1 year, a 20% increase in prices. That's a pretty significant impact. And then the study analyzed that tracts of land adjacent to an opportunity zone had slower appreciation. And I think that's just common sense. It doesn't surprise anybody. You see in a few of the bullet points here that some of the more attractive opportunity zones are located in New York City, in Brooklyn Heights, Brooklyn, Queens neighborhood, and then a few others are in areas like Waverly Place in Nashville, Tennessee, Charleston area of Boston, Massachusetts. So the opportunity zones are specific designated tracts of land that the governors would nominate and say, we want to have this as an opportunity zone because it met certain criteria for a low income community. Now, there was some flexibility there. Obviously, that standard is going to be applied and then interpreted a little loosely in different areas. All of the opportunity zones have already been determined, so there's no ability to add new opportunity zones. And when you look at the map here, there's almost 9,000. I think it's 8,700 plus opportunity zones. I've listed here a website to see all of them on the U.S. Treasury Department's Community Development Financial Institutions Fund. And then for many of you, when you want to look at your local state and see where the opportunity zones are, your best option really is just to use your computer and a search engine and look for those in each specific state because they're state specific. Now the terminology that's official is a little wordy. So the technical terminology is what's called a qualified opportunity zone, referred to by some as a QOZ. These are the land areas specifically designated to benefit from the Opportunity Zone program. Then you have what's called a Qualified Opportunity Fund, a QOF. Now this is the investment vehicle that people are going to put the funds into to obtain the Opportunity Zone tax benefits. And then finally, we have what's called Qualified Opportunity Zone Business Property, or QOZBP. And that's the actual investment needed to qualify for the benefits. That's the technical terminology the IRS uses. Let me switch over and show you the preferred terminology I'll be using for the purposes of this presentation. A qualified opportunity zone I'll just refer to as an OZ, or an opportunity zone. The qualified opportunity fund we'll call an OZ fund. And then the actual investment into the fund we'll just call an OZ investment. So I'll try and use that terminology throughout the rest of the presentation. Now let's look at an opportunity zone fund. Investors can obtain tax benefits if they have eligible capital gains that are no more than 180 days old. They need to purchase an equity interest in an OZ fund, and they're also going to have to file an additional form with their personal tax return. Now, what does the fund do? The fund is going to need to find and invest in qualifying OZ investments. They're also going to have to certify compliance with the IRS, and to the extent a fund doesn't certify or doesn't meet certain thresholds, they may have to pay penalties for noncompliance, and the fund may or may not even qualify. So that's something to be aware of. Now there are several OZ fund requirements. First, it must be an entity, what we call a regarded entity. I know many of you on this webinar are familiar with real estate, and many property owners, commercial investors, form entities to hold assets, real property assets. And oftentimes in real estate, that might be an LLC that's considered a disregarded entity for federal tax purposes, what sometimes is referred to as a pass-through entity. So everything flows through to the principal that owns that. For OZ fund requirement, it has to be a regarded entity. So C Corp, limited partnership, a limited liability company that's taxed as a corporation, and it must be in the United States. And the next one's very important. It must be at least 90% invested in opportunity zone businesses or real property. So these OZ investments. So that's a key aspect there. Certification. This is authorized by the U.S. Treasury, and the Treasury has authorized that an OZ fund can self-certify. I think the next point is really important because it shows you how much this program, in my opinion, is going to be taking off. There is no cap, there's no limit on the number of opportunity zone funds that can be created. And I think we're going to see thousands and thousands and thousands of funds created to take capital and redeploy it into these distressed areas. So that's really a benefit in a big way. Now, the fund itself, the fund must be at least 90% of the total assets must be into OZ investments. And it's got to be investments that are tangible property, purchased after January 1st, 2018, so certainly anything up until going forward qualifies, purchased new or substantially improved. used in a trader business, and then used mostly within the opportunity zone. And I'm going to say that loosely. There's some very detailed rules on what that means that came out in the latest release from the Treasury. So some proposed regs address that, and that's a little complex when it says mostly in an opportunity zone. Well, what is tangible property? Yeah, typically it's going to be land or lease property with certain qualifications, manufacturing equipment, buildings and structures, real property, office equipment and furnishings. Tangible property is generally not going to be cash, it's not going to be financial investments, or it's not going to be intellectual property. And the IRS is going to analyze this and look at these. It'll be tested twice annually. So it'll be tested to see are 90% of the Opportunity Zones Fund's assets in OZ investments. They'll look at it at 6 months and then also at fiscal year end. So to the extent an OZ fund does not have assets that meet that 90% or greater threshold at both of those time periods, they can face penalties. They could even potentially face disqualification of that. Now, these funds are open to what we call qualified and non-qualified investors, and let me try and differentiate that. The qualified investor is somebody who's rolling over deferred gains, so they're going to reinvest in an opportunity zone, and we'll talk about those advantages in a moment. A non-qualified investor is somebody who's just making an investment in this. They're not deferring gains, but they're just contributing capital to an OZ fund. So the funds themselves can have both qualified and non-qualified investors. And then investors on the other side, they can invest qualified funds, so those with deferred capital gains, and non-qualified interest into an OZ fund. So both of those can qualify. Let's start looking at some of the specifics. There are some benefits for those that are deferring capital gain. There's some benefits that kick in at certain time frames, and we're going to break these down. One benefit happens after 5 years, another after 7, and then finally after 10 years there's a very significant tax advantage that we'll touch upon on the next slide. So the capital gain taxes on deferred gains, gains that are rolled into the fund, these are deferred until one of 2 points of time. Either the investor leaves the fund, the OZ fund, or the end of 2026, whichever happens first. So something to be aware of, there's an end date with these where taxes are going to be owed. So that's something to be aware of. Now, there are 3 different levels of tax benefits with an OZ fund. So deferred gains that are reinvested, that are rolled into an OZ fund, that are held for 5 years are given a 10% reduction in the amount taxed. So 10% of the deferred gains go away. After 2 more years, at the 7-year mark, there now is a 15% reduction in the amount taxed. So that the investor would then only be paying taxes on 85% of the deferred gain. So right there, that's a significant tax advantage. The third bullet point really addresses probably one of the really attractive aspects of an opportunity zone fund. If an investor holds an investment for at least 10 years, the new gains that accrued within the OZ fund receive a full step up in basis. That means tax exclusion. So let me just give you a simple example to illustrate. Let's say an investor today invests $1 million in an OZ fund. 10 years from now, that investment is worth $2.5 million. So it's gone up by $1.5 million. They have tax exclusion on that whole, that entire new gain. The $1.5 million has 100% tax exclusion, and it's permanent. So you can imagine for investors the ability to make wise investments and have 100% tax exclusion on any new gain is very, very attractive. And that's what's drawing a lot of interest into opportunity zones. And frankly, it's drawing a lot of capital into these economically distressed areas, which is exactly what the federal government wanted to do. They want to help these areas out. And as you bring in capital to properties and businesses, you've got the potential to really help them out significantly. So that's a brief overview of the big benefits. Now, we got some guidance, ironically, just last week with the second release of proposed regulations from the Treasury. And I'm not going to go into all the details, but a few highlights. There was a little bit of additional leeway regarding investing the capital and a little bit more of a flexible approach. They clarified that a fund could include more than one investment. There were concerns that a fund would only buy one asset, and many investors want the benefit of diversification, not necessarily having all their eggs in one basket and having several assets. And that was clarified that could be possible to invest into multiple assets. They clarified that investors would be eligible for the preferential tax treatment as long as they held their investment for at least that 10-year time window, even if the fund itself didn't hold the asset for the full 10 years. They made some clarifications regarding how the working capital could be used for real estate development and operating businesses. And then they provided additional flexibility regarding some of the requirements of having 50% of the gross income within the opportunity zone. So there's question marks there. Obviously, something like a local grocery store would be probably obtaining most of the income in a local community. But with things like the internet and people doing sales on mail order over the internet, it became a little trickier if you've got a new business that creates jobs. But how do you meet that requirement of having the gross income within the opportunity zone? So there's a whole list of criteria that go into more detail on that. But it was very favorable for investors. And again, that's why there's so much excitement and really demand for opportunity zone investments. Let me walk you through a timeline of a typical investment. Let's say somebody makes an investment today where they roll deferred gain into an OZ fund, so 2019. 5 years from now, so in 2024, they then receive a 10% reduction on the tax on the original deferred gain. 2 years later, in year 7, they get an additional 5% reduction in the deferred gain. So 85% then of the deferred gain is taxable. 15% of it goes away. Now the next timeline is at the end of 2026 is when the taxes on that 85% now are going to be due. So on tax day, April 15, 2027, investors will have to pay taxes on the original gain minus that 15% reduction, so on 85%. And then finally, and this is really the big attraction again, 2029, 10 years down the road, any new gains on the profit within that OZ fund during that 10-year period of time are 100% excluded. So as you can see, there are many significant advantages along the way with an opportunity zone. Now I want to show you just a brief legislative history for 1031 exchanges, and we're close to being almost at the 100-year mark where 1031 exchanges have been in the tax code. And again, 1031s have been a part of the tax code, a vital part, because they really help businesses grow and expand and help investors improve the return on investment, sometimes within a geographic area and increasingly across state lines and moving capital around. So it's been a great tool to foster economic growth and development with real estate, both single-family rentals as well as commercial properties nationally. So 1031 came about in 1921. In 1979, we had a tax court decision which created the first delayed exchange, the Starker decision. 5 years later, Congress then codified the time deadlines that we're familiar with in a delayed exchange. So 45 days to identify and a maximum of 180 days, what we call the exchange period. In 1990, we got some proposed guidance from the proposed Treasury regs, and those were finalized in 1991. In the year 2000, we got guidance on how to do what's called a parking arrangement. You typically hear them referred to as reverse exchanges, improvement exchanges, reverse improvement. But parking arrangement structures, we got the safe harbor treatment in 2000. And then finally, beginning January 1st, 2018, with tax reform at the end of 2017, all personal property exchanges were eliminated. So from 2018 and going forward, only real property qualifies for 1031 exchange tax deferral. So let's get into the good stuff here. Asset preservation kind of coined this term here of doing a 1031 into Oz strategy. And what I want to do is share with you 4 or 5 ways that you could potentially combine a 1031 exchange with an opportunity zone strategy. So let's go through the first one. First one is you want to be aware that the rules for opportunity zones and for 1031 exchanges are separate. They're independent. So they're completely different tax code provisions. But we can use an opportunity zone as a fallback for certain 1031 investors. So here's what can happen. An investor initiates a 1031 exchange and they don't find replacement property that they want. Doesn't meet their criteria, or maybe they change their mind. But within that 45-day period, the qualified intermediary is holding the funds. They would then notify the qualified intermediary. So an investor has until midnight of the 45th day to identify. If they don't identify any replacement property, they then are not eligible to complete an exchange because only properly identified property qualifies for tax deferral in an exchange. So they notify the qualified intermediary that they haven't identified replacement property and they want to receive the exchange proceeds back on day 46. The qualified intermediary releases the proceeds directly to the investor then on day 46. Now the investor switches strategies. They don't do a 1031 exchange, but they're going to take that money and they're going to invest it into an OZ fund. So that investor has 135 more days to go ahead and invest that money into an OZ fund. So that same 180-day period that we have for a 1031 exchange, they have an additional 135 days from when they sold, because now we're on day 146, to invest that. And what's really interesting, and this is a significant benefit of an opportunity zone investment, is that because the investor is going to another tax strategy from Section 1031 to Section 1400Z to opportunity zone investment, they only need to invest their capital gain, not all of the net proceeds, into the OZ fund. So this is a big advantage of an opportunity zone investment. This is one strategy that can be used. Another way this can be utilized is an investor can complete an exchange. So start a 1031 exchange, sell a relinquished property, park the money with a qualified intermediary, acquire replacement property within the time parameters of a 1031 exchange. So their exchange is now complete. They've reinvested the money. This works for entities, what we call regarded entities. So it could be C Corp, S Corp, LLC that's taxed as a corporation partnership. It can't be a disregarded entity. Now, the exchange is over, and then the regarded entity now elects to obtain OZ fund status. So now we've got an asset that they own. They're then going to bring in new OZ funds. And so this could be coming from other deferred gain from another source. It could be from syndicated funds. It could be from a lot of different ways. But the money comes in now to substantially improve the replacement property that was acquired in the exchange. So we did a 1031 on the front end, and now we're using the opportunity zone provisions to take advantage of the opportunity zone. Well, what are the results of this? First off, we're able to defer capital gain in the 1031 exchange. That can be deferred past 2026 because it remains deferred as long as that investor does a subsequent exchange. Until they do a taxable sale, they keep deferring that portion of the gain. Now the gain that happens within the opportunity zone fund and the improvements, now it qualifies for the opportunity zone tax treatment. So this is kind of another twist on the interplay between Section 1031 and opportunity zone. Next slide, we've got another way to approach it. If an investor sells property held for investment, they have the option to select doing a 1031 exchange or taking that money, investing in an opportunity zone. So they could either, number one, do a fully deferred exchange. Number two, they cannot do an exchange at all and invest the gain into an OZ fund. Or some investors we're finding are choosing to kind of do a split strategy. Take some of the proceeds and do a 1031 exchange into other like-kind property, and take some of the money out directly and then invest that money into an OZ fund. So if they go with the third strategy, They're certainly going to want to split on a pro rata basis the gains between the 1031 exchange and then the gains going to the OZ fund. But it's another way to approach it. So anyway, those are 4 different strategies to combine Section 1031 exchanges with an OZ type strategy. On the next slide, I want to share 2 things that you can't do, that are not permitted. Number 1, you can't do a 1031 exchange into an OZ fund. And this one's pretty straightforward. Section 1031 exchange requires relinquishing real property held for investment or used in a business and acquiring real property held for investment or used in a business on the replacement property. Well, the fund is just that. It's a fund. It's not an interest in direct ownership of real property. Therefore, it's excluded. You certainly can't exchange out of property held for investment and go into a fund. That's not qualifying like-kind real property. So that can't be done. The second aspect here is a little more subtle, and I want to flush it out. There's a provision in Section 1031 referred to as the G6 provisions, and this provides certain limitations and restrictions on when an investor can get their money back, the exchange proceeds, when they've set up a 1031 exchange. And there's a lot to Section G6, and I'm not going to go into all the details, but essentially, in most cases, if a investor identifies replacement property and they're outside of day 45, so now it's day 46 or beyond, if they've identified replacement property, they then must acquire the property that they're entitled to under the 1031 exchange agreement. Meaning if they've identified 3 replacement properties and they purchase 1, they're still entitled to buy properties 2 and 3. So because they're entitled to buy them, the qualified intermediary must hold on to those proceeds until the expiration of the exchange period, which happens after the 180th day. So they've got to hold the proceeds till day 181. If the investor identifies replacement property and they're outside of day 45, right? They can't unidentify. They now have identified it. Then the qualified intermediary must hold the proceeds until they buy all the property that they're entitled to or day 181. If the investor gets the proceeds on day 181, they're now outside of the 180-day reinvestment time period required by the OZ rules. Therefore, they can't exchange into an OZ fund. So those are 2 things that can't happen with a 1031 exchange, an opportunity zone, and then I covered 4 things that possibly can. Now what I want to do is really do a side-by-side comparison with a number of different criteria and compare an opportunity zone investment versus a Section 1031 exchange. So I'm going to bring some slides up, and then I'm going to highlight with a green box and a check mark which one is the preferred strategy based upon the criteria. So first one, relinquished property, character, and use. And this one, opportunity zone wins out. Any property qualifies where with Section 1031, it must be real property. And it's specifically has to be real property used how? In a trade or business or held for investment. So a lot of types of property are excluded. So the advantage here is opportunity zone. Again, the same analysis on the purchase side. Opportunity zone wins on a replacement property, character, and use. Any property is broader can be acquired. So that's an advantage to opportunity zone. Now the next one's significant. I touched upon it, but I want to flush it out in more detail. Reinvest all the net equity. In an opportunity zone, the investor only has to reinvest the deferred gain. So if an investor sells a property for, let's say, $7 million, and they've got $2 million of that as gain, only $2 million of that deferred gain needs to be invested in an opportunity zone. Much more favorable than a 1031 exchange. In a 1031 exchange, if somebody wants full tax deferral, the basic rule is they've got to reinvest all of the net equity, so after closing costs, and number 2, have the same or a greater amount of debt on replacement property. And there's a caveat that you can go down in debt if you offset that by adding additional cash. So sometimes you hear this said of another way of rephrasing it is purchase at the same or greater net sales price and spend all the equity. But let's say the same investor selling for 7 million. Let's say it's approximately 3 million in net equity after closing costs and approximately 3.5 million in debt. For full tax deferral, that investor would have to purchase a property at $6.5 million in value, reinvest all of the net proceeds, and have the same or greater amount of debt. So clearly, opportunity zone is much more advantageous in that particular scenario. Next one, like-kind requirement. Again, opportunity zone wins out. Any property in the opportunity zone, any tangible property is going to qualify. Section 1031, only real property, and specifically real property held for investment, qualifies for tax deferral. So certain types of property don't qualify. Property that's going to be held for resale doesn't qualify. So opportunity zone wins out there. Next one, qualified intermediary required. In a 1031 exchange, in almost all circumstances, it is required. With an opportunity zone, it isn't at all. So the investor, when they sell, can receive the money, and then they hold the money, and then they have 180 days to have that redeployed into an OZ fund. With a 1031 exchange, at no point in time can the investor actually receive the proceeds, have what's called constructive receipt. They really need that qualified intermediary inserted into the process on their behalf. So that's an advantage, another advantage of an opportunity zone. Next one, time requirement for reinvestment. This one's a push. They both require 180 days. And let me expand upon that more specifically. It's 180 calendar days. So the calendar days are going to go through weekends, they're going to go through holidays. So in this one, the requirement is identical and there's no clear advantage. Now the next one, tax deferral on deferred gain. So an opportunity zone has that, but there's a deadline. At the end of 2026, the deferred gain is going to become taxable. With the 1031 exchange, the deferred gain can potentially be permanent. If that investor does another like-kind exchange and subsequent like-kind exchanges, until they sell in a taxable sale or until they sell with some taxable boot, mortgage boot, cash boot, they have permanent tax deferral and can keep reinvesting that over and over again. So there's an advantage for the exchange. Time restrictions on holding. Well, this one, 1031 wins. Why? With an opportunity zone, the whole intent is to have the capital go into that zone and stay there for a significant period of time, enough time to make a difference and to turn around the economy locally. So there are certain thresholds. There's an incentive to keep property there, keep the funds there for at least 5 years to get the first benefit, the exclusion of 10% of the deferred gain. Another 2 years for that 7-year threshold to get the 15% exclusion on deferred gain. And the biggest benefit comes after 10 years. That's where all of the new gain can be permanently excluded. 1031 exchange, there's no time restriction. The criteria for Section 1031 is that the investor must have the intent to hold for investment. So conceivably, somebody can do an exchange this year, exchange into an asset held for investment, and a couple of years from now do another subsequent like-kind exchange as that property is appreciated for another investment property. And maybe that one they hold for 2 or 3 years. And then they do an exchange for another property that maybe is held for 2 years. Doesn't, the time period. And then after that one they do another subsequent exchange and hold it for another 2, 3, 4, 5 years. So conceivably in a 10-year period, the 1031 investor could have multiple exchanges within that 10-year time period. And what are they doing? Well, they're redeploying their capital, acquiring more property, boosting their cash flow, and overall getting a better return on investment. So this one here, 1031, clearly wins out and is a preferred strategy. What about location? Opportunity zone? It's got to be in a specific area, one of those 8,700 designated tracts of land. Location, 1031 exchange could be anywhere in the United States. And not only can it be anywhere in the United States, but in terms of asset class, it could be bare land, it could be industrial, single-family rentals, office, multifamily, self-storage, very, very broad on not only location, but the type of asset class. Now, what about identification requirements? Here, the advantage goes back to the opportunity zone. There's just a requirement to put the money into an opportunity zone. Unfortunately, with Section 1031, this is an area where we've got significant restrictions. The investor must identify property by midnight of the 45th day. So there's a very finite time period. And not only that, there are very specific rules for identification. Under the three property rule, the investor can identify up to three properties of any fair market value, but they're limited to three. Under the 200% rule, they can identify an unlimited number of properties, but no more than 200% of the value of the property sold. And under what's known as the 95% rule, they can identify more than three properties and more than 200% of the fair market value of the relinquished property, but then they must acquire, actually close on, at least 95% of those properties. So much more detailed, much more specific when we deal with the identification rules. Now the next slide is going to be a huge advantage to opportunity zones. LLC or partnership interest. So in an opportunity zone, an entire partnership can do it, or individual partners on their partnership interest or their LLC member interest can do that. So this applies to a whole range of entities. Unfortunately, in a 1031 exchange, a partnership interest or an LLC member interest is excluded. You can't do an exchange out of a partnership interest or into a partnership interest. And there's some ways that we try to creatively work around that, and there are some potential solutions. But directly, you can't do an exchange on a partnership interest or an LLC membership interest. So this is a clear advantage to opportunity zone investments. Stock incorporation, opportunity zone, you can do it. It's excluded from Section 1031. Next one, adding capital. With an opportunity zone, you do need to add capital to develop or improve businesses or property. 1031 exchange, you don't. So there's an advantage on 1031. You do have the ability, if you want, an option to do what's called an improvement, sometimes referred to as a construction exchange or a build-to-suit, but it certainly is not a requirement. Next one, on related parties, 1031 has the advantage here. So you can't do a purchase from a related party in an opportunity zone investment. Now with Section 1031, it's a little bit more nuanced and complicated. You can do an exchange involving related parties, and beyond the scope of this short presentation, but in a simultaneous exchange you can, like a swap between two related parties, but both parties must hold it for at least 2 years. You can sell to a related party, that's permitted. You really can't in Section 1031 purchase from a related party unless the related party is also doing a 1031 exchange and you can substantiate that the principal objective was not tax avoidance. So it's possible to do a related party exchange under Section 1031, although I just want to suggest to you it's an area you want to get more information on and look at your unique facts and circumstances, because there are some certain requirements. And this is an area, by the way, that the IRS definitely does scrutinize transactions. A few more. Basis step up, reducing the deferred gain, OZ wins. Why? Because after 5 years, you get a 10% exclusion, 7 years, 15%. So some of the original deferred gain you don't have to pay taxes on. You only have to pay taxes on 85% of that deferred gain. Now, switching gears though, what about permanent deferral? Well, you do get permanent exclusion on new gain within the OZ zone. With 1031, again, you do have the potential. If an investor continues to do 1031 exchanges and subsequent exchanges for full deferral, you have the potential to do that over and over again. So until that investor sells in a taxable sale or does a transaction where they receive some taxable boot, there is permanent deferral on the gain as long as you keep doing that. And then finally, wrapping it up, tax deferral and gain would normally be recognized. We get the nod to Section 1031. The gain has to be paid at the end of 2026, so paid on April 15th of 2027. The gains can be paid. And again, with Section 1031, we can keep doing subsequent exchanges over and over. Now, why would we do an OZ investment? Well, because it gives the investor that whole time period between now and April of 2027, the investor has access and use of the capital that they would otherwise use to pay taxes. And if they can make wise investments, they can grow that capital and increase their investment returns. So that's why you got the time value of money, but you really have a significant opportunity. So coming down home stretch, let me compare and contrast simply in a summary here. When we look at opportunity zone investments, if you have gains that are not associated with the sale of real property, when I say real property, I'd probably be more specific. Real property held for investment or used in a business. Opportunity zone investments have many more advantages because there's really no way to do a 1031 exchange on gains not associated with real property held for investment. So this means there's a whole range of situations when an opportunity zone is far more advantageous. Investors selling a business, where you've got goodwill or covenants not to compete. Any personal property, because now personal property is no longer eligible for tax deferral under Section 1031. So these investments, we have a limited time window till the end of 2021. Investors have that period of time to decide to make an investment into an opportunity zone. But there are a lot of benefits, right? The deferred gain, basically 15% of the deferred gain goes away. So that's a good benefit. Investors have use of their capital. And then any gain that happens in the OZ fund going forward, new gain, new profit, is excluded if they hold it for 10 years. Looking at real property held for investment, there are a few situations where a 1031 exchange is more advantageous. One would be the investor retains control. They own the asset. So they have the ability to exchange in and out of it as they want, but they've definitely got more control. With tax deferral, the investor in the opportunity zone knows they're going to have to pay taxes at the end of 2026. And it would be, depending on how long they hold it, it could be only on 85% of the gain, but that's a certain tax hit coming down the road. With a 1031 exchange, the investor can continually do a 1031 exchanges and continue obtaining tax deferral over and over. Flexibility. In a 1031 exchange, the investor can decide when they want to sell, but they can also decide when they want to recognize a partial tax hit. Many investors, and this is a common misconception, many investors don't necessarily achieve full tax deferral. They might choose to take out some money called cash boot. They might choose to reduce their mortgage liabilities and have less debt. That's called mortgage boot. So they've got the flexibility to choose when they want to do that. And a big benefit of an exchange, if somebody does subsequent exchanges over and over and over, the basis of the relinquished property is rolled into the replacement property. And so they could have significant gains but not have to pay taxes on that. If they do that throughout their lifetime and they hold onto the property and don't sell in a taxable sale, they can pass on that property to their heirs who now get a full step up in basis to today's fair market value. Number 5, certainly there are some real estate related tax deductions. Owning real estate is something that the government encourages, so they provide all sorts of tax benefits for doing that, whether it's writing off interest, property taxes, obtaining depreciation benefits. So you directly own property, which gives you some definite advantages. A couple more. With the 1031 exchange, you have the option to refinance a replacement property post-exchange. So let me be clear on this. You do a 1031 exchange and you complete the exchange. The exchange is over. At a later point in time, you can come back and refinance it and pull money out of your replacement property. I just want to point out it's very key that you do that at a later point in time after the exchange is over. You can't do this anywhere mid-exchange. With opportunity zone investments, the IRS has not addressed this, so we don't have guidance. But today, 1031 is better. Finally, with a 1031 exchange, you're continuing to defer your gain. We know with opportunity zone investments, the taxes are going to be owed after 2026. We have no idea what the economy will be like. What's the real estate market going to be like? What's the stock market going to be like? If we're in a situation where investors maybe are in a challenging situation financially, they might be forced to sell other assets they own just to pay the taxes on that deferred gain. Investors in 1031 exchanges are not going to face that liquidity crunch because, again, they have more control of the timing of the taxes. Now, to kind of wrap up, I want to share with you on the next slide, asset preservation is a number of sites with social media. But if you want to share this presentation, we have a recording of it that will be on our YouTube channel, which is /1031 exchanges. You can obtain a copy of the presentation, and you can pass this on to investors, clients of yours that want an overview of these topics. And then very finally, you'll see the check mark there, by asset preservation being a leading national qualified intermediary. When it comes to opportunity zone investments, you want to review your specific situation with your tax and legal advisors or financial advisors. On 1031 exchange issues, asset preservation wants to be a resource to you and your clients. So anything related to Section 1031, investment property sales, please feel free to call asset preservation at our headquarters in California at 800-282-1031 or our office in New York at 866-394-1031. Visit our website, apiexchange.com. We have a lot of resources for investors about 1031 exchanges and various aspects. And then finally, we have an email, info@apiexchange.com. Now, this email is monitored by senior management at Asset Preservation. And you might have a question after hours or on a holiday, but we're very good at responding to that in a timely manner. So I want to thank you for your time. Hopefully you got some good information on opportunity zones as they compare to 1031 exchanges. And please feel free to call Asset Preservation anytime you have 1031 exchange related questions or issues. Thank you.